Let's go across. Naresh Jalan waiting by, Managing Director at RK Forging. Thank you, sir, for waiting so patiently over the last couple of minutes. So I want to start off by asking you, with regard specifically to the FY25 issues that you have. Have you plugged the loopholes completely? Are you super confident with regard to all the systems and processes that you have now put in place? And is there no concern with regard to working capital from your side at this point, given the Q1 FY26 numbers?
I think we are super confident in terms of plugging all the issues which had been there in FY25. And I think we have done utmost in terms of our process and other MIS is in place to ensure that no future reoccurrence of these issues happen ever in future. So I think we are extremely confident that the issue has been taken care and it is now on a gone days.
Mr. Jalan, a very good morning to you and thanks so much for joining in. It's Puneet this side. With that context, what is the kind of growth in terms of volumes that you are aspiring for FY26?
So FY26, we are looking at second half of the year to be extremely robust with the kind of capacity addition which we have had. And I think almost all our projects which we are doing WIP, most of these projects are going to be up and running by end of September or first mid of October. So we are looking at very high utilization in the second half of the year. And we are looking at almost 15 to 20% volume growth in the second half of the year.
So 15 to 20% volume growth, largely growth driven by the second half. Do you see that happening for both the domestic market as well as from the export market? And if you can give some color both on Europe as well as US in terms of exports, because we've seen the tariff impact coming in US. So do you expect that Europe will be driving the growth at least for this year?
I think going forward, not alone for this year, I think going forward for the next couple of years, Europe will be one of the major destinations for us in terms of our growth in terms of exports. While US or the North American operations will remain quite steady and quite encouraging for us. I think with tariff and other things which are there in place, it's what we feel at our end, it is going to be a temporary downside. But on the longer run, I think this is going to benefit the company. And with all these new opportunities in sectors which are untapped is going to open for us. So we are very confident that going forward, exports are going to do well as the domestic industry is picking up for us.
And that's going to drive a 15 to 20% volume growth, sir, you said. Would that also correspond with the top line growth that you will clock? And for how long are you seeing this kind of growth, 15 to 20%? Can we see it for the next 3 years? Is that visibility available?
So at least to be very sure that we are looking at least for 2 years, 15 to 20% growth. I think our capacities and other things are in place. And I think for FY26 and FY27, we are looking at 15 to 20% growth. And I think we will recalibrate going forward after that.
And sir, let me switch focus to margins. We've spoken about top line growth. Give us clarity here. Your margins took a knock in FY25, understandably. Why aren't we seeing a full margin recovery in FY26? Because that was just a one-off case, right? So give us the perspective on what is really happening with regard to margins. You've guided FY28, 24 to 25% margin, which is extremely strong. That's for viewer perspective. But sir, give us the perspective for FY26 and FY27.
In FY26 and FY27, I think you will be seeing a steady state of margins. I think with the kind of storm we have weathered in the past, I think right now this quarter has been transitory. So I think going forward, you will see steady improvement in terms of margins. And I think on the full year, on a standalone basis in RKFL, while we reach the last quarter of this year or the first quarter of next financial year, we should be back to our old margins. And I think that's the way we are planning it out. And you will see a steady state of margins going forward.
Okay, so sir, steady state, by steady state, you mean 20 plus? Is that something that one can expect by early next year?
Yes, on a standalone basis, you will see 20 plus margins in the next financial year.
So that's extremely strong because you'll do around
yes.
5,500 crore of top line in FY27 with a 20+% margin number.
Yes, in terms of we at a console level, we are not looking at 20%. We are looking at close to 18 to 19% in the console side. On the standalone side, we are looking at almost 20+% margins in the next financial year.
And Mr. Jalan, just one point you made, in terms of growth also, that you're anticipating strong growth from Europe over the next couple of years. What's driving this confidence? Because commentary from most players in the passenger vehicle side has been subdued, at least for this year. They're not guiding for next year. So confidence for you for Europe, is that largely being driven by the commercial vehicle space, largely to drive the growth? And has that also resulted in some of the key order wins that you had in this quarter?
Yes, Puneet, I think with the new order wins which we have had, I think with whatever is going on in North America, we have tried to work out with our customers and pull ahead all this new order wins. And we will start seeing revenue coming in, which we were expecting next financial year to start playing for us in next quarter onwards. So all these new revenues from the Europe are going to be impacting or positively impacting the balance sheet on the upside, and is going to more than compensate us for whatever we are right now facing in North America operations.
But is that largely being driven by the commercial vehicle space? Because we've seen subdued outlook coming in from the passenger vehicle side. So would that be a fair assumption to make without quantifying any kind of numbers?
Yes, it's fairly to assume that it's all coming from a commercial vehicle space in Europe.
Okay. Sir, shifting focus to North America and maybe completely off topic with regard to your business, how is the North American market taking the tariffs? And what are the structures which are being put in place, at least in your sector or segment? Are these tariffs being passed on to customers? Are customers willing to take on the tariff cost on their books? How is it playing out?
So I think it is very early. I think if you really see, since April, I think it is back and forth in terms of the quantum of tariff. I think now we have a certain certainty that what tariff is going to be. So I think you will see coming days and months things to stabilize. For RKFL, I think 20% of our volumes which are being exported to North America goes directly into US, which will be facing tariff. Rest of 80% either go into Canada or go into Mexico, which do not come under tariff regime. So I think so this 20% we are negotiating with the customers, and I think for us, I think it is a very clear message to our customers that they will need to pay for that. And most of the customers or most of the suppliers from different countries, I think that is way that they are working it. I mean, I think tariff, all said and done, will be paid by the US consumers. Neither the country specific is going to pay these tariffs, or nor the companies who are suppliers who are going to pay these tariffs.
Jalan, you mentioned the 20% will be impacted by tariffs. I'm guessing that is larger industry issue as well. So are you seeing any kind of consolidation in those orders in the US because of this aspect?
No, I think we have neither lost any sorry, neither we have lost any orders or nor I think we are facing any types of pushback from the customer. Basically, the market in North America is down almost by 50 to 60% in terms of manufacturing. So that's the concern, and that's the pushback we are having from the customer. So I think as and when they start consuming parts or as they start pulling parts, they will be paying tariffs, and that's the way ultimately the vehicle cost is going to be passed on to the consumers.
From my side, Mr. Jalan, you'd mentioned last quarter that you will be infusing capital into the business, and roughly about 200 odd crores, which was the erosion from the inventory issue. Any kind of update that you can provide us in the timeline for FY26? And are you still committed to infusing capital at 2,100 rupees per share?
Yes, we are committed to putting in 205 crore rupees into the company, and I think we are just waiting for NSE approval. Once we receive the stock exchange approval, 25% of the warrant money is going to come in immediately, and the balance money before March 26 is going to be funded into the company. So entire warrant money we are committed to get into the company before the end of this financial year.
What will you do with that cash balance inside the company? Will you pay off debt?
Yes, we'll utilize. We are looking at almost 300 crore rupees debt reduction in this year. So basically, this entire money is going to be utilized to pay off the debts.
And so FY27, I'm more fascinated with regard to that commentary. 1,000 crore of EBITDA is what you will do. What about amounts getting blocked in working capital? Do you see that happening as well, both FY26, FY27? What's the visibility there?
No, I think right now we are not. We have also calibrated our. Most of our working capital usually gets blocked in our exports in the North American market, and with the consumption being low over there, accordingly we have recalibrated our dispatches to our warehouses in North America, and I think we will not have any funds blocked in terms of inventory sitting in our warehouses in North America.
Excellent, Mr. Jalan. This has been a very candid chat. Thank you for that.